In 1985, the average American home cost a little over $100,000. Today, that same home, adjusted for size and location, costs over $400,000. Most people see that and think, incredible investment, quadrupled in value, the American dream, delivered. But here's a question almost nobody asks. If homes are such a great investment, why does the average homeowner who sells after 10 years often walk away with less real wealth than someone who simply rented and invested the difference? The price went up. That part is true. But somewhere between 1985 and today, America quietly stopped noticing the difference. This video is about that gap. And once you see it, you'll never look at a for sale sign the same way again. For most of the 20th century, this conversation didn't need to happen. Homes were genuinely affordable relative to income. Mortgage rates were stable. Property taxes were modest. Insurance was cheap because disasters were rarer and rebuilding costs were lower. Then several things changed at once, and they changed permanently, not temporarily. Home prices detached from wage growth. Insurance premiums, especially in coastal and wildfire-prone states, started rising faster than almost any other household expense. Property taxes climbed with assessed values. Mortgage rates swung from historic lows to multi-decade highs in a matter of months. And through all of that, one belief never got updated. My house is my biggest investment. That belief made sense in 1985. In 2026, it needs a serious second look. Let's separate two things that have been fused together in the American mind for decades: a home as a place to live and a home as a financial asset. As a place to live, a home is priceless in the way it matters to you personally. That's not what this video is about. As a financial asset, a home has to be judged the same way any investment is judged, by what you put in versus what you actually get out. Here's what goes in every single year, whether the market goes up or down. Property taxes, typically 1 to 2% of the home's value, annually, forever. Homeowner's insurance, and in many states, this has roughly doubled or tripled over the last decade due to climate-related risk repricing. Maintenance and repairs. Industry estimates put this at added up, and a homeowner can easily spend 4 to 7% of their home's value every single year just to keep the asset functioning. For the home to be a good investment in the financial sense, it has to appreciate faster than that ongoing cost. For decades, in many markets, it barely did. Here's where it gets uncomfortable, because this is the part real estate conversations almost always skip. Imagine a home purchased for $400,000. 10 years later, it's worth $560,000. That's a 40% increase. Looks fantastic on paper. Now subtract what actually went into maintaining and financing it over that decade. Property taxes at 1.5% a year, roughly $60,000 over 10 years. Insurance, averaging out at a conservative $2,500 a year, $25,000. Maintenance at a modest 1.5% a year, another $60,000. Mortgage interest paid in the first 10 years of a 30-year loan on a typical rate environment. It isn't profit. It's the gap between two numbers that ignores everything that happened in between. Compare that to renting the equivalent home and investing the difference, the down payment, the gap between rent and full ownership cost, into a diversified index fund averaging historical market returns. In a large number of real markets over the last 15 years, the renter-investor comes out ahead in real wealth. Not because renting is inherently smarter, but because the home's hidden cost structure quietly eats the homeowner's apparent gain. The cultural script says rent is money thrown away, a mortgage is money building equity. The reality is more complicated. Rent buys you housing and nothing else. That part is true. But a mortgage payment isn't pure equity building either, especially in the early years when most of it is interest, not ownership. Real estate agents, lenders, and home improvement shows all have one thing in common. They profit when you buy, sell, or renovate, none of them profit from you running the honest math on holding costs. So the narrative that survives in public conversation is the one that benefits the industry, not necessarily the one that's most accurate for your bank account. And here's the irony. The people who made real money in real estate over the last 40 years were rarely the average single homeowner. They were the ones who bought multiple properties with other people's money, used leverage aggressively, rented them out for income, and treated the home as a business, not as the house I live in and call my investment.
For the average American buying one home to live in, the financial outcome has far more to do with timing, location, and interest rates than with any inherent magic in homeownership itself. Now, zoom out from one household to the entire country. For decades, homeownership equals wealth building was treated almost as economic gospel in America, encouraged through tax policy, mortgage interest deductions, and a cultural identity built around the idea that renting is temporary and owning is permanent success. But the input costs underneath that belief have shifted dramatically. Insurance markets are repricing risk in real time as climate-related disasters become more frequent and more expensive to rebuild from. Property tax assessments have risen with home values, even in places where local services have.
So maybe the question isn't, should I buy a home? Maybe the real question is, when you bought or when you buy, are you buying a place to live or are you buying an investment? Because for most people today, those have quietly become two different decisions with two different answers. You can absolutely choose to buy a home knowing it might not outperform other investments. That's a completely reasonable choice for reasons that have nothing to do with spreadsheets. Stability, roots, a place that's yours. But if you're buying it because someone told you it's the best investment you'll ever make, it's worth asking where that idea actually came from and whether it was ever really about your wealth at all or about someone else's.